Well, we finally have it. We finally have a red day in the market. It's been a long time. We've gone through a good streak. The past month has been good, but now the stock market's reminding us that it can still go down. Maybe fear will set back in and we'll start trading down to the new lower lows that all the bears are hoping for. This past month has not been good for the bears. They're saying it's bear market rally. They're still holding their short positions. They're having a tough time as the market's going up. So a lot of investors right now are actually celebrating that the market's going down. But either way, it's being dragged down by one piece of news here that I want to go over, which is Target and how this is affecting all retailers. Now, Target did give us advance notice. This really shouldn't be a surprise. They said, we made a mistake with our inventory, with our demand. We ordered a bunch of products that we no longer want. And because Target doesn't have a lot of the fulfillment, they don't have a lot of the storage that a lot of companies like Walmart and Amazon have, they have to get rid of it. So to get rid of all of this supply that they ordered, all these discretionary items, they had to offload it like crazy, which caused their earnings per share to fall off a cliff. Now, we're going to be going over their entire earnings report. We'll be looking at the article. I have the actual earnings report pulled up here. I want to review all of it with you in this episode. But we also have some other news to get into as well. We have the legendary, the mythic Chase Coleman with Tiger Global. This is a guy that you can barely even find a picture of. There's like 2 or 3 pictures of him online, even though he's worth over $10 billion. And he's one of these legendary tech investors over the past 2 decades that has trounced the market. He's just crushed the market up until last year. Everything came crumbling apart over the past year. His fund is down 50%, and he's turned to the next big thing to save him and his fund. Potatoes. That's right. Potatoes. We're going to go over Chase Coleman's potato investment in this episode. And then finally, we have some other news I want to get to. One of the investors that I've been following that's lesser known, but still a remarkable investor in my opinion, is called Josh Tarasoff. And I've talked about him in a previous episode. He's a younger guy, but he manages a lot of money. Right now, he's managing a quarter of $1 billion, so $250 million. And he has a very concentrated portfolio that mimics a lot of the companies I have. He has Amazon and Salesforce and Google and Shopify and all these different companies. And I want to go through his trades because he's one of the few people that accurately identified a lot of the qualities of Amazon way back in 2006 when nobody else was really doing that. So we'll go over Josh Tarasoff's portfolio update as well now that we have his 13F. So we have a lot to jump into in this episode, a lot to go over. If you haven't already, hit the subscribe button, hit the bell icon, then you get notifications every time I upload. And like always, I'll start off with a quick portfolio update. This is the Story Fund. It's one of 2 of my portfolios. I have a dividend growth portfolio, then I have a more high growth tech focused portfolio called the Story Fund. And this one's been struggling more than the dividend portfolio. The dividend one has been crushing it over the past year. This one's been struggling because of a couple companies. Netflix is one that I got hit on. I got hurt on Netflix. We had a couple other companies. Alibaba didn't do well. The rest of the companies in my portfolio have done okay. So we're in the path right now of trying to make back some lost time. We're trying to make back some losses over the past year. And I think we're doing a decent job at that. Over the past 30 days, we're up $15,300, 16%. Amazon has really popped over the past 30 days. Google has been okay. Basically the market average. Netflix has made a good bump over the past 30 days, 25%, $2,500. And I'm still one of the few that I'm still bullish on Netflix. I still think the company has a bright future, has huge network effects. I think a lot of the competitors will get weeded out over time. I think that Netflix and Disney and Apple and Amazon are some of the only companies that are going to be able to reach scale. Microsoft up 13%, Adobe up 14%, pretty average in the tech sphere. Salesforce up 11%, Apple up 15%. These are all average gains if you're invested in tech-like QQQ companies. And then we have Crocs up another 7.8%. This one's done really well since investing in it. This is a bit different of one because it's not a tech company, but it's a very high growth company. They bought Hey Dudes. They own the Crocs brand. The bet is for me that it's not a trend, that it won't fizzle out in a year. That's the bet I'm making. I could be wrong. I could lose money on it, but it is a smaller position, and I'm willing to bet that the Hey-Do brand will grow rapidly and make up for any slowdown in the Crocs brand. And overall, this company still should grow its revenue and free cash flow by at least 20% this year. So I'm excited about this one, but it's already moving up in the green. Berkshire has been mostly flat, up 5%. And then Alibaba is one that I've been incrementally lowering my exposure to. It's one of the only ones. In fact, it's the only company in my portfolio that's in the red in the past 30 days. So Alibaba is one that I've been lowering my exposure in. So over the past 30 days, we're up 15,000. A very good month, outperforming SPY and the QQQ, but all time we're down 22,000, underperforming the S&P 500. And this is what it looks like visually, updated just this morning. The S&P 500's red and the story fund's in blue. My portfolio is underperforming right now, which I do not like to see. And I am very competitive. I do want to catch up to the S&P 500. I believe I can. I've given myself some time because you shouldn't really judge your investment performance over a short period of time unless you're doing a very short-term strategy, something like day trading. Since mine are long-term investments, Amazon and Netflix and these type of companies are long-term theses, I need to give myself a couple years to see how this really plays out. But right now, I have to be transparent. I have to show how this looks. This is what it looks like. The S&P 500 is in the green by 8%. This is considering every single buy and sell I've done. We're still down 9-10%. So we're making up some ground. We're closing the gap a little bit, but we still have a long ways to go. Now, having said that, let's go ahead and jump into some of the market news today. The markets are red across the board. Bound to happen. The market doesn't just go up forever every single day. I don't think this is news to be panicked about. The market's looking at some uncertainties with the Fed. I think they'll continue to raise rates aggressively. 75 basis points is my guess. So I think the Fed's going to continue raising rates. And then we have some other concerning news, but I don't know if this is the main reason the market's selling off. But Target's earnings did not help the market today. They are abysmal. And I say this as an owner of Target in my dividend portfolio. So I own Target stock, and I'm still saying the company's earnings were abysmal. Now, if we skip to just the top and bottom line, the EPS of the company was 39 cents is what they reported versus 72 cents expected. This is a massive miss. They made just over 50% of the earnings expected. The revenue matched, so they hit their revenue, but they dramatically missed their earnings. Now, the stock isn't cratering right now. It's down only 3%. Because again, a lot of this was expected. Investors should have been wise. They should have been privy to this happening because Target did communicate with investors. They said, look, we ordered too much of the wrong stuff. It's a problem. We're going to deal with it. We're going to discount this stuff, get rid of it, and then we'll be back on track. So stand with us for 1 quarter. This is not a long-term problem. We're going to get over this and get through it really quickly. And that was the right approach. It hurt Target at the time. They dropped 30%. A quarter back, but now they're not getting hurt as bad. They're down 3%. They say in the earnings report, this is the most recent one, they say that comparable sales grew 2.6%. When it says sales, that means revenue. So the sales grew 2.6% on top of 8.9% revenue growth last year. They say the 2.7% reflected traffic growth. It also reflected continued strength in food and beverage, beauty and household essentials. The company gained unit share in all 5 of its core merchandising categories in the second quarter. So even though the headline of this was not great, them going down that much in EPS, some of the actual pieces of data here aren't too bad. They're gaining actual market share, so they're taking from competitors. Even if they're not making much money doing it, that's a good thing. The store comparable sales increased 1.3% on top of 8.7% growth last year. Digital comparable sales grew 9%, following 9.9% last year. They say the operating margin rate was 1.2%, reflecting gross margin pressure from actions to reduce excess inventory, as well as higher freight and transportation costs. This is very low, 1.2%. They're normally above 4%. So their margins actually compressed around 70% this quarter. Not good to see, but again, they're painting the picture that this is a temporary thing. As a result of the company's inventory actions in the second quarter, the company reduced its inventory exposure in discretionary categories while investing rapidly in growing frequency categories. Additionally, fall season receipts and discretionary categories were reduced by more than $1.5 billion. So they had all of these hard goods, is what they call it. the type of things like toaster ovens and coffee machines and different things that people buy for their households, kitchen items, all of those hard goods. And they had way too many of them. They are not able to sell them. All of those hard goods were ending up on the discount aisle, right? They're just trying to get rid of them at any cost, sometimes discounting them up to 50%, because everybody bought that stuff during 2020 and even 2021, but they're not buying it this year. This year, people are trying to afford groceries. They're trying to afford things for back to school. And that's where they had this mismatch of inventory. So now Target's saying, instead of trying to hang on to this stuff and selling it for the normal price, we want to get rid of it and clear room for the stuff we actually want to sell so that our shoppers are happy. Now, of course, they mentioned the earnings per share here, saying it was 39 cents, down 89.2% from 2021. So a 90% decrease in EPS since 2021. And this is something that I have highlighted with Target. It's been a concern of mine. In fact, I tweeted about this just a couple months ago. Target's earnings per share really spiked over the past year. In fact, if we look at this on a quarterly basis, I think this paints it more clearly. There's their normal rate of growth, this nice gradual growth of Target that we come to expect, and then it doubles in a single year. In 2020, the EPS goes up double. When I see such an anomaly, this enormous EPS growth in 1 year, I'm a little bit, as the kids say, sus. I think it's just a bit suspect when the EPS grows that much, and I think there's a decent chance for reversion back to the mean. And this is something that I've mentioned many times. In May 18th on Twitter, I tweeted out, I've held Target for years, but refused to add to my position for the past couple of years simply on the basis of the rapid earnings per share spike. It seems like an anomaly that was likely to have mean reversion. Made the valuation look lower than it is. And I showed that same exact earnings per share chart. Now, I'm still bullish on the company long term, but I think that this is going to be a short-term struggle. And the CEO of the company in the earnings release actually mentions the problem with this inventory. This was the big issue. Quote, I'm really pleased with the underlying performance of our business, which continues to grow traffic and sales while delivering broad-based unit share gains in very challenging environments. I want to thank our team for the tireless work to deliver the inventory right-sizing goals we announced in June. While these inventory actions put significant pressure on our near-term profitability, we're confident this was the right long-term decision to support our guests, our team, and our business. And they go on to say that they have very positive outlook. Their 2022 year guidance isn't bad. I actually think that's pretty strong guidance given this quarter. They say they're still going to grow sales low to mid single-digit range, which is completely fine for a company like Target. And the operating margin rate in a range of 6%. So they're going to get their margins back up after they've been compressed this quarter. So even though this quarter was terrible for Target, they at least gave strong guidance. And I think that's why the stock isn't taking too much of a beating today. It's down 3 or 4%. Now, moving on, we have to get to some important news, which is Tiger Global and the fall of Chase Coleman from grace. He's now moving into potatoes as an investment. Now, before we jump into Chase Coleman and the potato investment, I have to give a quick shout out to today's sponsor of the video. It's FTX US. You might know them as the cryptocurrency exchange. I don't do a lot with cryptocurrency. That's not really my thing. I like productive assets like Adobe and Amazon. And luckily, FTX is a fully fledged fintech platform. They also now offer stocks. This is available to anyone. You can sign up now using one of the links in the pinned comment below. There's one for mobile or desktop. When you sign up, use the refer code Carlson. That lets them know that I sent you. It credits you $10 amongst your first $100 trade. Now, FTX does it a little bit differently. They actually charge a very minor amount per trade. So they'll charge 1 penny per share purchased or 0.05%. which is a tiny amount per trade, but in exchange for that, you're not getting your information sold from payment for order flow. You can look that up, payment for order flow. That is what almost every free brokerage does. They sell your information. There's lots of hedge funds that can front run your trades. You get worse fills on your trades. And for that, you save a penny per share. So FTX likes to be more straightforward. They charge you 1 penny per share on a trade or 0.05%, whatever's cheapest. And then they don't sell your information and you get better fills that way. Now, they're also part of FINRA and SIPC insured. And overall, I've really enjoyed using the brokerage. I literally have had no problems with it. It's worked very, very easily. So there's a link in the pinned comment below. Go ahead and sign up, use the referral code Carlson, and let me know what you think. Now let's go ahead and jump into this Tiger Global Chase Coleman news. Chase Coleman is this guy here. And I recognize this picture because this is one of the only pictures ever used for Chase Coleman. The guy's somewhat like a mythical creature. you can't really find any videos of him. You can't find interviews of him. You can't find much audio of him. And there's only a handful, maybe 2 or 3 pictures of him online. But yet he's worth over $10 billion. So this guy is unfathomably wealthy. He's extremely wealthy, and he has ran this incredible hedge fund called Tiger Global for the past 2 decades, yet he has almost no online presence. Like, he doesn't even exist. It's a pretty incredible feat to accomplish that. Now, Tiger Global has been one of the most envied hedge funds of its time, one of the ones with the most notoriety. Other hedge funds would talk about Chase Coleman and Tiger Global as being this incredible, intelligent investor. He had market-beating returns for the past 20 years. And not just market-beating, but market-crushing returns. We're talking about 20% annualized returns for 20 years. That's an incredible performance. But what's happened over the past year is all of this has been crumbling down. We have Tiger Global blaming inflation after a 50% drop in the flagship hedge fund. 50%. If we look at the actual performance and what this drop did, it only takes one big fall to bring down a history of good performance. If you accidentally blow up your fund and make it go down 50, 60%, that erases a lot of prior good performance. The losses have chipped into Tiger's enviable record. Its flagship fund, launched in 2001, so we're talking 21 years ago, has now recorded a net annual return below 15%. Now, this is still good performance. So even though he's dropped 50% in value this past year, they're still above 15% in this fund. That's pretty incredible. We're talking about a very enviable record here. After a 50% drop, still having 15% annual returns is very good. But before this drop, the returns were much better, closer to 20%. So this really did chip into their enviable record. And here's the sad part. The long-only fund, launched in 2013, has returned an annual average of less than 4%. So launching a fund in 2013, one of the best times to launch a fund, where you could get an easy 10% plus return per year, returned 4%. This is what's happened to Chase Coleman and Tiger Global. And what's become more apparent with this is looking at their 13F filing just released a couple days ago, it shows that Chase really had no plan. He had no plan in case things went wrong. He was so set in his groove. He had a nice little thing figured out, which was to invest in the most high beta companies, the most high risk companies, let the Fed pump up the market, ride that wave for 20 years, and make a lot of money doing that. But once things changed, once inflation came in, it reveals that he had no plan. And what's most revealing about him having no plan is this latest investment. Tiger Global's new big thing, potatoes. This is from the Financial Times. Coleman's hedge fund has gone long Potatovation. We're talking about innovation with potatoes here. Chase Coleman is desperately trying to douse out Tiger Global's portfolio of dumpster fire tech stocks and limit the already record book-worthy 50% loss in its flagship fund this year. The latest 13F regulatory filing revealed that in the second quarter of the year, it had ditched Robinhood, Zoom, DocuSign entirely and hacked back positions like Coinbase, Carvana, Snowflake, and DoorDash. Tiger Global invested in all of these companies. Just like Cathie Wood. Cathie Wood gets all the attention because she's on the media. She's on CNBC. As we already discussed, Chase Coleman stays out of the news. So he's not getting a lot of the attention here, but it's really deserved. He should be getting more attention for how horrible his performance has been over the past year. He was invested in all of these usual suspects, the Zooms, the DocuSigns, the Teladocs, Carvanas, DoorDashes, all the companies that you see in the tech investors' portfolios. I disagree that these are the best tech investments. I think these companies are not that innovative. I think most of them are relying on easy money. I think the companies that are really innovative are companies like Microsoft and Amazon, frankly, but that's a whole different discussion. Regardless, they say Tiger Global's overall public equity exposure to stocks is now down to $11.9 billion, according to the 13F. At the end of 2021, it stood at $46 billion. So they reduced the equity fund exposure by over 70%. They're not invested in stocks as much anymore altogether, and they say that the timing of this fire sale was unfortunate, given that many of these stocks have actually bounced back in July. So Tiger Global had their fund go down 50%, then they sold most of their fund at rock bottom right before July's epic bounce back in price. Many of the companies, like Robinhood, which they sold at the bottom, have now bounced back up over 35%. The end of the second quarter. Carvana's shares have more than doubled over the same time period. So they sold and missed this bounce back over the past 30 days. But then we get to the most concerning thing here, which is a new investment that Tiger Global made this past quarter. The Idaho-based Lamb Weston is one of the world's biggest producers of frozen potato products. This is a new holding in Chase Coleman's portfolio, like the French fries that you can find in your local supermarket. Lamb Weston might seem like a weird investment for a major hedge fund overwhelmingly focused on fancy tech bets. The Financial Times says they sourced the website, this is the potato company's website, for any mention of machine learning, leveraging the blockchain, quantum computing, or big data, but it really does seem dedicated to just shipping gargantuan amounts of frozen fries. So they actually went through and they used the hodgepodge, the list of all these different buzzword terms for tech companies, and they tried to search if this company does any of it. And it seems like all they do is they just ship a lot of fries. But this is the direction that Tiger Global's going. Now, this is the new holding in Tiger Global's portfolio, Lamb Weston Holdings. It seems like a half-decent company here. I'm not bashing this company. They earn real cash flows, they have stable revenues, but I think the real problem with this investment is not the investment itself. I think Lamb Weston is a fine company, but the problem is what it reveals about Tiger Global is that they didn't have a plan. They're doing things on the fly. They're trying to change their investment thesis halfway through a crisis, which is not the situation you want to be in. So what I take away from this is, even though you might have had good performance for a long period of time, even though things have been going good, never get complacent. Never think that life is going to be easy. Never think that your investments are going to do well all the time. Constantly be on guard, constantly be proactive, looking for the best valuation at any time. Chase Coleman was caught off guard. He had done so well for so long that he didn't have any concept in his mind of things going this poorly. And when it happens, now they're in desperation. Selling out of their holdings before a big rally, moving into potato companies. They really lack a game plan at this point. So keep proactive and stay on top of your investments. Now, there is an investor that I think is actually doing a better job, even though he doesn't have the reputation of Chase Coleman. He doesn't have the huge financial assets under management. He's a good investor. His name is Josh Tarasoff, and he controls $250 million. So he does have some money under management, but he runs a very concentrated portfolio that I like to keep track of. With the latest 13F just filed a couple days ago, we get a look at what Josh Tarasoff has been up to. And I really like the way that he's been managing his money. I think he's been dealing with this downturn in a really good way. First of all, he has a portfolio that looks very similar to mine. We do have some crossover in the companies that we've invested in. One of them is Amazon. He's very reluctant to move out of this company, despite owning this company for literally over a decade. He's owned it for a long time. He still owns Amazon. In fact, he just recently added to it. Salesforce is his next biggest holding. He reduced this one by 7.5%. So we have a minor trim on Salesforce. We have another big holding, which is Brookfield Asset Management. He reduced this one by 7.5%. This is one that I'm very intrigued by. I'd like to invest in it, but I can't feel like I understand Brookfield Asset Management as much as other companies. So I've kept that one on the sidelines. Another company, another big position in my portfolio is Google. He has this as 11% of the portfolio, and he did add more to Google. Shopify is a company that I don't think most people are fully familiar with what they're doing. Most people view them as a website builder, and they're way more than a website builder. They're huge into fintech. They process so much in payments, and they're even doing things like loans, like a bank. They're loaning out to different small businesses that use their platform, that run online businesses. And the way that they pay themselves back is they say, we'll take 10% of all your revenue from your merchant that you use us until we're paid back. So Shopify can almost guarantee that they'll get paid back. That's an advantage they have over other lenders. They can scrape part of the revenue from the merchant that they're giving the loan to. The next up is Netflix. And this is one that I thought was very interesting to see. Josh Tarasoff increased his position in Netflix by 45% after the sell-off. This is a huge addition into Netflix. Now, the total percentage of portfolio has gone down. 6.65% is in Netflix, but that's not because he sold any of it. He's added 45%. The only reason the percentage of portfolio has gone down for Netflix is because the value of Netflix has gone down. So Josh Tarasoff is actually more bullish on Netflix now. He continues to add to this position. And personally, I think he's right on it. I think that Netflix offers good value right now. Now, Netflix is a heavily disputed one. It's going through a tough time right now. Most investors disagree with me on Netflix. It's not a popular investment, but it's interesting to see that this is the one that he actually added the most to over the past quarter. We have Amazon and Netflix as being the two biggest additions. We have other companies that he cut, Trupanion, Spotify, Monday.com. We have Burford Capital. Monday's an interesting one, not enough of a moat. Too discretionary, these to-do lists. Spotify's one that I had to sell out of simply because of the economics. They have to prove to me that they can make real money before me investing in them. And then Burford Capital is not one that I'm familiar with. Now, if we go over to the activity feed, we can see companies that he sold entirely out of. And the one company that he exited his position entirely is Peloton. So he was invested in Peloton at one point. He decided to completely remove it from the portfolio. I think a very smart move. I think that he should have done this before, but he's doing it now, and I completely agree with this sell. So out of these things that he's done with his portfolio, I agree with him. He bought more Netflix, bought more Amazon, bought more Google, and bought more Shopify. He reduced some positions probably to raise cash for that, but overall, I really like these trades, and exiting out of Peloton completely, in my opinion, is a good move. So there's an update on Josh Tarasoff's portfolio. I think he made a lot of moves. Now, it looks like the day is going to close out in the red slightly. We have the market mixed overall. Some companies are in the green, most are in the red. And then we have meme stock mania. Bed Bath & Beyond up 22% today. If we look at the past month, we can see a little bit of a spike here. Just a minor spike. It's up 316%, which I think is a decent gain over a month. But this is meme stocks. I predicted in my 2021 predictions of 2022, I predicted that next year, meme stocks would get worse, not better. They become more of a thing. Even with interest rates going up, the memesters, the people doing this, Wall Street bets, would do it more ferociously than years in the past. And that's what we're seeing right here. So if you want to jump into these things, if you get lured in, if you think that you're going to make some real easy gains, be careful, because just as these companies go rushing up, as there's lots of people bidding up the price using leverage, it will come collapsing down. Now, one last thing I'll mention is we have made a lot of improvements to Qualtrim. We have company profiles and news articles in there. We have more explanation of debt between capital leases and different things. We're constantly improving this website. And if you want access to it, you can get it with a free trial by using the Patreon link below. So if you want to try this out, you can try it out for free. There's a link in the description below. Let me know what you think. That's all for now, and I'll see you in the next update.